Sometimes people get confused with the accounts payable and accounts receivable, okay? Is it debit or credit? They try to put them both on the liability side or the asset side, or sometimes even in the income statement, okay? An account receivable is an asset because it means that you have the rights to receive some cash as a company in the future. If I had a piece of paper that said I have the right to receive $1,000 in 20 days, that's quite an asset, isn't it? Okay? An accounts receivable is an asset. It goes on the balance sheet. Okay? An accounts payable means that you have to pay out cash in the future, like your student loan. So that is a liability, and it goes on the balance sheet in the liability side. Are you with me? Now, sometimes people get confused with accounts receivable and revenue, okay? And they go, okay, I'm doing the income statement. Do I add the receivable amount to the revenues, or how does that work? No, those are two separate accounts. Receivable is an asset. Revenue, of course, is a revenue account that goes on the income statement. Now, they might move in conjunction with each other, but accounts receivable is not added to revenues or anything like that. Let me give you an example that sometimes helps, okay? Let's say we started a company at the end of the month. Like, let's say we started it, like December, 28th. We started it right after the Christmas break, okay? And we only made one transaction to a customer for the last 4 days of December. Only one, okay? Let's say we sold services worth $850 on account to a customer, okay? Well, what's the Chapter 1 way of recording that? Oh, not cash, is it? Because it's on accounts or on credit.
Yeah.
So we sold $850 worth of services on accounts or on credit to a customer. Accounts receivable is affected, isn't it? And that goes up by $850. You with me? And what else is affected? Use your words. What other count? I provided $850 worth of services on account to a customer. What is it?
Revenue? Or no?
Expenses?
I heard it out of there.
Is it a liability?
No,
No,
Revenue?
because they're
it's
paying
revenue.
you. Oh,
We provided the services, right? Did we remember the revenue recognition principle? We recognize revenue when it is earned. When is it earned? When we've provided the product or service, okay? So, I want to make sure you guys have that. If you guys need a little brush up on your transaction analysis, this is where I want you to go back to those exercises that we did, like 112, 111, 113, 114, around there. And I want you to practice that because you need to know those, okay? You always need to know what accounts are affected. Do they go up or down, and by how much, okay? So if you're a little fuzzy on that, make sure you review that, okay? Okay, but do you understand now where we are, right? Okay. Now, if I was doing an income statement at December 31st, and again, this was the only revenue transaction we had, would I say my revenue for that month ended December 31st is $1,700?
No.
No, it's $850, right? Okay? You see what I'm saying? You don't add that over on the income statement. No. There's $850 revenue on the income statement and then $850 on the balance sheet that shows it's still receivable. You could have millions of dollars worth of revenue and no receivables, couldn't you? What sort of situation would that be?
They pay cash.
If you only sold on cash, right? Okay? So I don't want you to think that accounts receivable is added to revenue or anything like that. They might move in conjunction with each other, but they're not the same thing.